In this week's update, stunning US seasons continue. Massive week for lithium stocks and the second in the educational series. My name is Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. Okay, let's start with a quick market perspective. The US earnings sets the tone for the world, certainly for the American market, but everyone else pretty much follows. And the American earnings season is just continuing to pan out in pretty stunning fashion. We've got 88% of the S&P stocks that have reported so far have beaten earnings, and the average earnings beat has been 18.4%. Now, both of those numbers are just way above the long run averages. So this really is an exceptional earnings season. And remember, this is not percentages against last year's results. This is the beat after months and months of analysts already raising estimates. They've been raised significantly over the last 3 or 4 months. So after all that, they're still beating at that sort of rate, and by nearly 20%. So it really is a stunning earnings season. If you look at the financial year 22, the expectations for next year for the S&P, that's been ratcheted up another 11% and is now at $215. So that's a blended average. And that corresponds at the current level of the market of around about a PE of around 20. Now, given the earnings growth rate and the low interest rate environment and the huge amount of stimulus that's in the system and is going to be in the system for some time, I think a PE of 20 is probably about right. That's at the index level. So I don't have a problem at all with valuations in the market in general. Now, some stocks are overvalued, but some really high growth stocks are, whilst on the surface by some of the traditional metrics might look expensive, but if you really understand where the businesses are going, they're actually quite cheap. And many companies, and this is the important thing, many companies are actually raising guidance because that's what the market is really pricing on. The market is always looking 6, 9, 12 months ahead. So it's starting to try and price in the second half of 2022. So really it's about guidance more than the earnings that were just achieved in the last quarter or the last 12 months. Now, if we look at relative strength, there was a bit of a flip over on Friday. We've had the yields coming down, and that occurred during the week. I think the 10-year bond yield got down to about 1.12 at one stage. But the jobs report on Friday caused a sudden spike in the yield. The yield went up to 1.3, and that was obviously beneficial for financials. So we did see a bit of short-term money coming out of some of the higher growth areas and going into the financials, which had a really good session on Friday. But look, that's one data point. I'm not going to change horses based on one night, one reaction to an economic data point. So XLK technology and XLY, which is consumer discretionary, so two of the main high growth aggressive areas of the market, were essentially flat on the session. They were up slightly, down slightly. But look, semiconductors, which have been held back a little bit for the last 6 to 12 months because of supply chain issues, their reports are coming through really well now, and the sector is breaking out. So that's that's looking terrific. Turning to American stocks, the S&P was up by just a tick under 1% for the week. Now, as you know, I've been talking about this for 3 or 4 weeks now. The seasonality is not great. August, September, two of the weaker months of the year, particularly September. But the earnings beats offsetting that are just amazing. So it's, we may end up with an index really just sort of going sideways to, maybe slightly up, slightly down, but probably not doing a great deal because these two forces are offsetting each other. September is historically the weakest month of the year, but looking at the market from an index perspective is the wrong thing to be looking at. you really need to be looking at individual stock performance. It can be very different to the index, and it is very different to the index. And I'll show you a number of charts that back that up. Just a quick peek at Bitcoin, so that I don't omit it. You can see we've been in this range for some time, but we now seem to be breaking out of that range just at the point that everybody was convinced that Bitcoin was going to break 30,000. In fact, it did, but it turned out to be a false breakout. We've rallied back in a bit of a short squeeze to the top of the range, pulled back a little bit, and have now surged on again on pretty good volume. So from a technical point of view, Bitcoin would appear to be recovering. And that's probably all I'm going to say on that particular point. Now let's just look quickly at the S&P. So there's the big picture monthly chart. Here's the secular bull market we're in since 2013. My view is, and history would back me up on this, and that's that we're probably looking at least 2030 for this secular bull market to continue, and possibly even towards 2035. However, along the way, there'll be some cyclical bear markets, being falls of anywhere from 20 to 50% at the index level, which, when you're in the middle of them, seem like the sky's falling in. And I would expect at least another one, possibly two, during this current decade. So that's the very big picture. Back to the dailies, you can see, look at the moving averages, the 20-day on the green, the 50-day on the blue, and the 200-day on the red. And they're all lined up perfectly. The price is above all of them. So we still have a very strong uptrend at the S&P level. The NASDAQ, similar. So same orientation there. But the Russell 2000 small caps are lagging a little bit, and I've put this band of support in about 4 or 5 weeks ago. We bounced off the bottom of it, and I guess you could say that it's holding at the moment. That's probably the best you can say about the small caps. So certainly where we saw terrific small cap strength back here in 2020, and it even got a bit speculative, that has now by and large disappeared, and it's the earnings results around large cap companies that the market is really rewarding and focusing on at the moment. Now on that point, let me just show you some examples of companies that are beating earnings, and most importantly, how the market is reacting to it. Because if you remember a few weeks ago, I was talking about buy the rumour, sell the fact, and that to a degree still plays out in markets, because it's just one of the dynamics of how markets work. But if the earnings beat is good enough, or the outlook statement is good enough, then the market just cheers wildly, and the price gets punted up very, very strongly. So the 10 or so stocks I'm going to show you now are where there's been a very good earnings report, and the market has rewarded that stock handsomely. And that's why I said earlier that just looking at the index alone can be, quite misleading. You really, most people aren't buying the index; they're buying individual stocks, and so you need to look at individual stock performance. So this is AMD, Advanced Micro Devices. Just note the candles, the steepness of the rise, the volumes. Quite a stunning breakout. This is Nike. Here was the earnings report here. We got a massive gap up, and it's just continued to go on with it. Gapped up to $153, and now it's at $173. So it's continuing on. In the same area, this is Crocs, another footwear manufacturer. Big gap up on earnings, and it's just continued to head on up. This is Carvana, which is disrupting the automotive sales and maintenance industry in a major way. Probably as big a disruption as many other areas such as fintech or in the biotech area. So they came up with a 170% earnings surprise. The market was expecting a loss. They actually achieved a profit, and we got this massive gap from 330 to 370. Now, it closed down a little bit on Friday because things got a bit a bit negative for technology stocks, but nevertheless, a huge gap up on the earnings result. In the healthcare sector, this is one of the healthcare majors, HCA Healthcare, so probably a $100 billion company. They beat earnings by 38%. Look at the massive gap, and that gap is held, and it's looking like it's starting to edge higher. And by the way, none of these are recommendations. This is purely to illustrate the market reaction to favourable things. So we can have individual stocks, even though we may get a correction in August or September or some sort of pullback. But that doesn't mean that every stock goes down. So you don't need to abandon the market. You just need to focus on the stocks that the market is rewarding well. In the semiconductor space, this is ON Semiconductors, a 28% earnings surprise. Look at the gap, and so far it's been able to hold it. Terrific volume. This is Atlassian, which is an Australian company, didn't ever list here, but listed in America. Obviously an earnings report that the market loved, and huge gap up, and has gone on with it. And this is Unity, which is more of a digital toll road, really, helping to promote the 5G revolution. This was the earnings report, tremendous response to the earnings report. So, it's how the market is reacting that's the important thing. And just finally, this is a SMH, this is a semiconductor overall sector. You can see very clearly we're in uptrend. All the moving averages are aligned. We've now got a breakout. And so the semiconductor sector has now joined several other sectors in breakout. So I think it's really important to understand what's going on beneath the index level. Now, the US dollar had a mild gain overall for the week, but most of that was done, in fact nearly all of it was done on Friday night in response to the jobs report. And the 10-year yield spiked up to $1.30. So the negativity on the day to the growth sectors, technology, consumer discretionary, etc., is really a bit mystifying, because when the yield was about 1.5, it had come down from 1.75. The market was cheering these technology stocks wildly, and now here we are, even lower, and yet there was some selling on Friday, and that's why I don't think it'll be sustained. I think that'll just be a bit of a very short-term reaction. And the VIX back down to 16, and so things are fairly calm at that sort of level. Now, just checking in on the US dollar, you can see quite a kick up on Friday, and the Australian dollar. I'll have a bit more to say on that in a minute, but you can see we're clearly in downtrend. We're getting a little consolidation here, but all you can say at the moment is that we're forming lower lows and lower highs. It's definition of a downtrend. So that's where the Australian dollar is sitting. So 73.09, a bit surprising from my perspective, given the big falls that we saw in iron ore last week, and also a stronger US dollar. I would have thought the Aussie dollar would be lower, and who knows, that might be coming this week. The Australian dollar, the Australian 200 ASX 200 index rose by 2% across the week. Energy was certainly lagging other sectors, but the huge winners, the real surge occurred in lithium, and I started talking about that last week, and it really was a huge week for lithium. So let's take a look at some charts in that area. So first of all, the ASX 200. So quite a nice smooth trend going on there. But if we look underneath at the sector level, there's materials. So the things to look at are the direction of the moving averages, how consistent they are, and where the price is in relation to those moving averages, and everything stacks up very nicely there. But if we go to healthcare, it's also looking quite positive in the short term. It's been in a bit of a washing machine over the last 6 to 8 months. Financials trending quite nicely, but it's really energy. You can see the difference between materials. So there's the BHPs and the Rios and etc. And then this is energy, which looks quite different and rather sad. So in the Australian market, it's the sector that's really struggling. Now let me just show you some of the lithium stocks in Australia, just to give you a sense of what's happening if you're not someone that looks closely at charts all the time. So this is Vulcan Energy. We had a massive run last week from 9 and finished at 13.25. If we look at this is lithium, but it's EMN, European Manganese. So again, battery materials. You can see a tremendous surge on Friday, but had been moving already and quite big volume on Friday. If we look at Novonix, which is, and these aren't recommendations, these are merely illustrating trends that are happening. So if you're caught in stocks that are either going down or not doing anything, then you just need to be aware that there are parts of the market where prices are going up very, very strongly. So Novonix, which is not only a battery materials stock, but is also a battery technology stock. So they're developing technologies to be used by others and tested by others. And of course, one of the other big winners was Lake Resources, and it moved from the mid 40s to the mid 60s. So that was a terrific week for lithium stocks in Australia. Turning to precious metals, gold got smacked hard on Friday, fell $40 down to $17.65, and that was a lot more than the US dollar strength. So this was not just a currency move, and gold is struggling a bit at the moment. Now, long term, I'm still positive, and I'm talking 1, 2, 3 years out. But in the short term, you've got to respect what the market is doing, and at the moment, gold is certainly not in favour. It's certainly positioned as far as the futures market goes for this to be close to the lows, but it just doesn't seem to be able to gain that momentum to re-enter an uptrend. So that's just the way it is with the precious metals market at the moment. GDX looked like it was starting to turn up. It was leading the way, some promising signs, but there was a large spike down on Friday, and that kills the mild recovery that looked like it was underway. So let's just have a quick look at that. So there's the gold price on a weekly chart. We're still in an overall consolidation that has really been running since about the middle of February. But if you look at it on a daily, it's a bit more starkly obvious what happened on Friday. So we were holding okay, and then that jobs report, really caused a sell-off in the gold market. And GDX, so the gold miners, you can see big gap down. Could have been worse. Didn't really go on with it. Gap down and then pretty much stayed closed where it opened. So I guess it's not as ugly as it otherwise might have been. Turning to other commodities, copper was down a bit on currency, and nickel similarly. But clearly lithium is flavour of the month at the moment, and other battery materials, but lithium is at the forefront of that. Crude oil, West Texas Intermediate down to 68.09, so that's come off nearly $10 in the last month or so. And if you look at XLE, which is the energy stock index for America, it's now below a declining 20-day moving average, and it's underperforming the S&P as well. So let's just have a quick look at that. So there's XLE. So you can see the 20-day moving average, the green one, has rolled over. The 50 has rolled over. The 20 is now below it, and the price is below both of those short-term moving averages. We're forming lower highs and lower lows. Now the 200-day is still turning up or pointing up, and it may provide some support, but this is one of the weakest sectors now in the US market and also in the Australian market. And there's a bit of a hint of a head and shoulders pattern forming there. It's a bit early to say that, but if that were to continue to build, then we could see significantly lower prices yet in the energy sector. There's spot copper and spot nickel, so just off a little bit on the week. Now, turning to the second part of the investing game plan that I started last week. So just a quick recap of what I said last weekend. These are the key points. It is possible to learn how to time the market to gain a significant advantage. You might read otherwise. The people that say that just don't know how to do it, or haven't applied themselves enough to find out how to do it. But you're not going to do that based on fundamentals. Fundamental analysis is not going to help you time the market. It's just too big a lag for that to happen. The other thing I talked about last week is how to decide when to play hard and when to go easy. What are the indicators? What are the ratios and the charts that you should be looking at? The third thing is getting your personal objectives clear. And until you've done that, your return objectives and your tolerance to risk and all those sorts of things, until you've done that, you're really not even at ground zero in terms of putting together an investment plan. So it's just so critically important. Now, one thing that I am going to do, I'm going to bring this education all together in a more complete format and in much greater detail with lots of examples. So that is coming. It's going to be a handful of weeks away, but all of the things that I'm on, the concepts that I'm showing in these little snippets in the weekend video are all going to be brought together in a bigger overall product. Now, in video one, I talked about using the fundamentals for timing as a wasted effort. However, let me be very clear here that doesn't mean that you don't pay attention to the fundamentals. Understanding the key criteria can assist greatly with your success rate. Because one of the things that it allows you to do is that stocks that you might have bought, which are, poor quality stocks, and you bought them because the price chart looked encouraging, but it was never going to be sustained because the company's actually a really poor quality company. So paying attention to the fundamentals does help you cut out many of the lemons that you might otherwise buy. So the two go hand in hand. But obviously, in terms of timing the market, then technical analysis is got to be king for sure. Now, the key concepts to pay attention to, basic metrics like PE ratios are completely useless in isolation. If you look at a stock and you see that its PE is 10 or it's 25 and you draw a conclusion from that, you're just wasting your time because it's just a meaningless number. What you require is at least 3 to 5 years of in-depth data to see the trends, and the data is on earnings, it's on revenue growth, it's on the strength of the balance sheet, it's on cash flows, it's on a whole range of things that you need to see, and individual data points are just not what you need to do. You need to see trends unfolding in those data points. And you also need to understand what the company is doing and what the environment that company is in is doing, because any of these analyses of profits or cash flows or whatever it might be are only relevant in context. So if you don't understand how the company operates and you don't understand the environment that the company's in, then these numbers are nothing more than just interesting numbers. They don't actually mean anything. So you need to understand the essential context, and that just requires a fair amount of shoe leather just to work your way through it and constantly stay on top of it. The next concept is that it's critical to assess the skills of management, particularly with small companies. An average quality company with high quality management is always going to be a better proposition than poor quality management riding a good horse. So the skill of management, absolutely critical. And there certainly are ways that you can determine that without having to go out and interview them. It's, there are certainly strong indicators in the numbers. The next thing is just the importance of return on equity, return on invested capital, and the cash flows. Now, all of this will be, contained in what I will be putting together. But those things are really important. So hopefully you get the idea that there's just such a bigger picture than just looking at the current PE ratio and trying to make a decision on that. It's just not a valid thing to do. Now, once we've identified a quality growth stock, then we need to formulate strategy about how we're going to work with it. And I'll talk more about this next week, but often I use a core and a trading approach, which makes life just so much more productive. It makes life so much less stressful. So I think it's an approach that would suit a lot of people. More about that next week. Now let me introduce, and again I'll flesh this out more, but let me introduce a concept which is very difficult for most people, and I acknowledge that, and I understand why it's difficult. But when you're in a losing situation, which is also deteriorating or not getting any better, so the price is going down, the fundamental results might be getting worse. So you're in a losing situation, and the natural human inclination is to hang on, wait for the rebound, even if it takes you a year or two. But the concept that I want to get everyone to think about is that parcel of money is now worth what it's worth. The loss is already there. And you're hanging on, hoping that loss comes back to break even or something close to it. But what I would propose is that how much you're behind is irrelevant. If you started with a $10,000 parcel of money and it's now worth $5,000, that's already there. The loss is there. And so focusing on the loss is not the right thing to be focusing on. The only question in my mind, is what stock will allow that parcel of money to grow the fastest with the highest probability? And so the more that you can train your emotions to detach from your profit and loss situation and just focus on probabilities. And let me give you a graphic example of this with stocks that I guess a lot of conservative investors would be familiar with. So let's look at AGL, so AGL Energy. So back in 2017, this stock used to trade at $28. And you can see what has happened to this stock in the last 4 years. We're now trading at $7.36. So it's been, an incredible fall from grace. And you'd be a brave person to say, well, this is going to turn up at some point and I'm going to get a significant slice of my money back. Now, it might. But again, what is the probability? Everything is pointing down. And it could go lower. There's nothing to say that this could not go lower before it stabilises and turns back up. But let's compare that with a stock, let's say, like Wesfarmers. Now, Wesfarmers is going up. Now, if you took that depreciated parcel of money in AGL and you put it into Wesfarmers, which one do you think is going to grow that parcel of money back to where it was before the fastest and with the greatest degree of reliability? So hopefully everyone can give that concept some thought, because the more that you can train your mind to think that way, the better your results will be. The next video, next week, I'm going to be talking about the concept of entry techniques, what to look for to get a significant advantage. I will touch a bit on core and trading portions, and then continue to move through the hierarchy of thought from there in coming weeks. Now, just to wrap it up, final thought, trying to anticipate a correction is a fool's errand. Now, there's a lot of people out there now that, because of the time of the year and because the market has gone up so much, and they're just generally bearish anyway, they're predicting a correction. And a lot of people are on edge. I know, I get the questions, but really you're focusing on the wrong thing. And I know that, again, the human inclination is it's nice to be right, but there's a bit of a decision to be made here. Do you want to be right or do you want to make money? Because often those two do not go together. And sometimes you've just got to remain flexible enough in your thinking and go with what the market is giving you. And that is a more profitable outcome than sticking to your beliefs, which you believe to be right, but turn out to be wrong. This market is not overvalued, given the results we're seeing coming through. Some parts of the market is overvalued, but a lot of individual stocks are not. And also considering the environment, the low interest rate environment and the massive stimulus. So there is actually no need to have a correction. We don't have to have one. We might get one, but we don't have to have one. But that's all at the index level anyway. Just focus on individual stock performance. And that's why I showed you all those stocks in America that were just beating earnings by a country mile, and on stocks in Australia that are going up very, very rapidly. So keep your focus on that area. Portfolio analyst last week, we looked at portfolio construction, which I'm putting a lot of focus on at the moment. We also looked at my 10 largest conviction stocks in Australia. So my 10 largest stocks are obviously my highest conviction stocks. Otherwise, why would they be my largest? And I showed the entry prices, and all of that was available in last week's portfolio analyst. Anyone that hasn't taken that trial, that information was available there. There was also another addition to the 10-bagger portfolio, a stock that I think has the capacity over time to add significant multiples to its current share price. So it was a pretty well-received session last week. All right, that's it for this week. There's the website and email address for anyone that wants to get more information about what we do. And I'll be back with you next weekend. Cheers.